Okay, so to start, I just wanted to survey the room. How familiar are people with options, derivatives, DeFi? So maybe put up your hand if you're familiar with these concepts. Okay, perfect. So this is going to be a great presentation for most of you because we'll cover a lot of the building blocks of DeFi. And I think because it's a more kind of cozy room, feel free to just like raise your hand and stop me along the way if you have any questions. We can kind of make it a more interactive presentation today. Cool. So I'm Vic. I'm one of the co-founders of Cega. We are an exotic derivatives protocol. We are operating on both Solana and on Ethereum. And I'm here today to tell you guys more about how the building blocks of DeFi came to be, the past, the present, the future, and what our involvement is with it. So excited to share. Cool. So one of our main theses is that DeFi derivatives drive institutional adoption, which is going to be critical for the growth of crypto and DeFi in large. So to begin, we'll take a look at the past. We'll dive into where we've come from and also give a quick primer on what derivatives are. So there's no mistake that DeFi is here to stay. If you guys look at the small dot on the left, that's basically where the TVL of DeFi was in 2019. So it's just at about $200 million, which if you think about the market cap of even some of the most like meme coins nowadays, it's larger than that. So DeFi was very small at the time. Fast forward to 2022, at the peak of the DeFi run, TVL was close to 77 billion. That's almost 400x in just 3 years. Seems pretty big, right? Put that dot in comparison to the overall market cap of traditional finance, and you see that we are still very, very early, still very nascent, and there's a long, long ways to go. The TradFi market cap today is more than $100 trillion, right? So it's a T, not a B, and that's where we can go. One of the common misconceptions with DeFi is that people think it's been around for a very long time, and they usually think about that timeline with respect to the blockchain timeline or kind of BTC. But in fact, like BTC's been around for quite a while now, but DeFi really only came to be in the last 5 years. And I would actually argue that really only came more prominently to light in the last 3 years. I guess like how many of you guys participated in DeFi Summer? Yeah, okay. So I think DeFi Summer is probably one of the first kind of breakouts for DeFi, and I'm sure there's gonna be more to come. So we think institutional adoption is key to mass adoption. Well, why? Part of this is looking at the growth curve of BTC and some of the kind of key events that have helped it grow along the way. So for example, in 2013, the first crypto institutional asset managers arrived on the scene and started managing BTC. Do you guys know who that might be? They're also a VC, venture capital. So it's Pantera. They're one of the largest VCs. They also happen to be one of our investors. So 2013 was also kind of a bold period for BTC. If you look at 2016 as well, 2016 was a moment where governments started actually recognizing BTC as a valid currency as well. And that institutional / larger body adoption helps these crypto assets go mainstream. Okay, we'll kind of go into like a learning mode for a little bit. We'll do a little bit of DeFi derivatives 101. So to start, a derivative in its purest form is actually a solution to help manage risk. And I know that might seem a little bit confusing, but we'll kind of go into some of the examples of it. So here on the screen, I have a picture of a farmer. And you guys are probably wondering, well, what does a farmer have to do with derivatives? So agriculture is actually one of the first industries that depended or relied on derivatives. And I'll give you an example. Let's say that you are an apple farmer. So you grow apple trees and you collect apples and you sell apples for a living. And you have consumers of the apples that make apple juice. Well, why might you, the farmer, want derivatives or care about derivatives? Well, it's because your business and the yield of your apples are subject to matters outside of your control. For example, maybe there's bad weather one year and all of a sudden your yield is no longer as high, or the quality of your apples have changed. But you actually want to maintain a business where the price of your apples don't fluctuate that much, and the apple juice makers who are buying it also don't want your apple prices to fluctuate too much. So you might create an agreement where you agree to sell your apples at a future date for a certain price. And that is, at the core, is essentially an options contract, which is a derivative. So if you use the past example, this contract around apples doesn't actually require the person to own any apples themselves. Derivatives are wrappers around underlying assets. So you can create derivatives around stocks, around bonds, around crypto, around apples, around oil, around whatever you want. Derivatives are ultimately based, or they're derived on these different underlying assets. They're also a contract between a buyer and a seller, so you need two parties to be involved. You need someone to be selling the contract, and you need someone to be buying the contract. So in our example, right, we have the farmer who says, hey, I want you to have the buyer who says, I want to have the choice to buy your apples for $100 in a month from now. And the seller, or the farmer, who says, okay, well, if you want that insurance, just pay me a little bit of money right now, and I'll give you that insurance for it. In DeFi, this contract happens not over pieces of paper, but it happens over the smart contract. And it's a tokenized version of that same contract that we just talked about. So if we also look at how derivative markets came to be and how that evolution has been shaped, it's actually kind of interesting because this set of flows is largely based on what we see in terms of TradFi. It's how we view capital markets to form. So on the very left, you start with asset creation, right? So for example, you have some stable coins or some value that's being accrued to a token of sorts. So you can think of, DAI or USDC or whatever you might have it. Next, once you have these tokens of value, you need a way to sell them. So you need spot markets, right? So AMMs, clouds, exchanges, ways to kind of sell these tokens that are worth money. Once you start selling them and people start owning the tokens, then naturally lending markets form. So lending markets are basically, well, I own these assets. Maybe you want to borrow my assets and do things with it at some rate. And here, and now we have lending and investment rates forming. The next two boxes are based on what we see in TradFi and what we think DeFi is naturally going to take place as well, which are futures markets and options markets. So once you have lending markets take place, naturally the next thing that you want to do is you want to apply leverage, and you want to also hedge or take speculative bets on these different underlying assets that you have. And the differences between futures market and option market are basically, it comes down to the payoff of these different options that you're buying, whether or not it's linear payoff. So in a linear sense, when markets move up, the options gains and losses move up, and non-linear meaning that you have more protection over or configurations over the options payoff. Okay, cool. Now let's take a look at how DeFi derivatives drive institutional adoption and how institutional adoption also flywheels back and helps grow DeFi. So just I guess a quick round of hands, are you guys familiar with what institutional adoption means? Like what these kind of institutions are? So just a super easy example is most of us in the room are probably regular DeFi retail users, right? So you have a wallet, you have some money, and you invest in tokens or coins or these different things. Well, an institutional investor is someone that invests large amounts of money on behalf of their investors. So they're probably managing hundreds of millions or billions of dollars. And so the needs of institutional investors are much more different than that of retail investors. So the four big areas that we are going to cover in terms of what their needs are benefits and utility, supply and liquidation, trust and safety, and lowering the cost of operations. So on benefits and utility, there's three things that institutional investors care about. They care about having real returns, not necessarily high yields, but real returns where the yields are coming from places they understand. So I'm sure for all of us that got wrecked by like Olympus or other Ponzi-nomic launches in 2022, we know that like one of the most important questions to ask for most DeFi protocols is like, where is the yield actually coming from? And institutional investors care about this a lot as well. The second asset they care about are better trading mechanisms. So this could be in liquidation, it could be in investment duration, lockups, and all of those different features as well. And the third one is a flexible view on the market. So what this actually means is that as an investor, you might say, hey, look, I want to I want to invest and I want to take a position on the market based on the market staying flat or stable. Not necessarily that it's going to be completely bearish or completely bullish. And a more flexible view on the market is actually something that is desired by a lot of these larger institutions. Moving on to supply and liquidity. Supply and liquidity basically says, well, if I have $100 million to trade, can I even buy $100 million worth of derivatives from the market? Like, who is actually providing that supply? And then similarly, if you're buying or creating the derivative, who's actually taking the other side of the position, right? Who is creating the liquidity for that options class? And what's really interesting here is that there's kind of like a chicken and egg problem where if you aren't creating derivatives, you don't have liquidity. If you don't have liquidity, you're not going to have derivatives. So how do you kind of break that puzzle piece? Well, we think that the way to do so is you have to actually first create derivatives and you have to first find demand from the people that want to take that position. Once that is established, then you can find market makers or other parties to provide liquidity for it. Once that liquidity is provided, it actually kind of flywheels back because if you're a market maker and you're hedging your positions, you're going to go back out and you're going to buy more derivatives. And so this flywheel is something that's going to happen in DeFi as more institutional money flows in. The third aspect is trust and safety. So if you're a builder here, or honestly, if you're any user, like we care about this probably as much as institutional investors do. The only difference is that institutional investors care about having additional controls on top of that. They care about knowing the transparency of the flows in DeFi, right? So where is the money being moved to? And with DeFi, that transparency is basically guaranteed on blockchain because you can just view all transactions from a wallet address. They care about counterparty risk assessment, so who is taking the opposite side of the trade. And they also care about institutional custody, right? So this means I'm investing on behalf of my investors. How do I make sure that the custody controls are in place correctly for all my operations to go smoothly? And the final piece that they care about is lowering the cost of operations. And so this, I think, is one of the coolest parts about DeFi, which is just like, if you guys consider today going to your bank and buying an options contract or buying some investment from somebody, before it reaches your hands, there's probably like dozens of individuals, humans, people who've touched contracts along the way, and every single employee at a bank essentially is a line item for cost, and it reduces your bottom line as an investor. You get less yield because of it. With crypto, with blockchain, with DeFi, you're investing through contracts, you're investing through code, and inherently code is free. What we pay for are gas fees. And so the thing to optimize for here in DeFi is basically, how do I optimize smart contracts for gas? And how do I optimize the other associated costs with managing a smart contract in such a way that we can deliver higher returns for everybody involved, right? Whether it's retail investors or institutional investors. So in this sense, creating a robust DeFi derivatives ecosystem directly leads to the creation of a larger blockchain ecosystem. It's a flywheel that works together and boosts DeFi's growth in unison. Okay, cool. So we've looked at the past. We've looked at how institutional investors will help drive the adoption. Let's take a look at where we are now and where we're headed. So from our vantage point, so Cega, so we are an exotic options protocol. We see the landscape today in terms of three large buckets. The first one are exchanges. So this is where you can go and you can buy your options. The second one is operations. So operations, you can think of it as kind of like back office. You can think of it as the back end for a lot of these different financial contracts. And then the third bucket is tokenization. So this is who is actually going and creating these tokenized smart contract representations of derivative options in the blockchain. So to start, let's talk about exchanges. So exchanges are probably one of the more mature and saturated fields out there today. I'm sure lots of you guys have probably used some of these protocols or companies, whether it's GMX or perpetuals or DOPEX, to buy your options. You can buy perpetual options, which are basically options with no expiry, or you can just go and buy regular options that have expiry. But regardless, lots of places for you to buy options today, lots of exchanges that are out there. If you look at the back office, so this is kind of operations to provide the necessary operational processes to enable DeFi. There are some companies that are doing interesting things. There are some companies that are providing for some of the problems in this space, but actually by and large, we need more work on the operations side. So if there are any builders out there looking for ideas, billion-dollar ideas, like this is an easy place to work on. Some of the existing solutions out there today, for example, you have counterparty credit analysis. So there's a company called Credora that we work with, but essentially they help DeFi protocols get an understanding for the credit worthiness of the market makers or the different partners that they're working with. You have on-chain auctions and RFQs, which are basically requests for quotations. And this is basically when you go out and you work with your counterparties, how are they providing you with bids for the different trades that you're trading? And then volatility indexes like Volmex, which provide volatility that you use for pricing these different options. What's missing today, honestly, are things like risk management, so your ISDAs, which are contractual legal paperwork that help you create binding contracts to work with your different counterparties. There are clearinghouses. We need more institutional custodial solutions and even insurance for counterparty risk. So just lots of different areas of growth on the operations side that help fuel DeFi as well. The third area that we think is also ripe for disruption and a lot of innovation is in tokenization. So tokenization means who's actually going and creating the tokenized representations of these options contracts on the blockchain. So you have today a lot of vanilla options, DOVs. So you have Ripon Finance, Jones DAO. You have exotics. So Cega, we work in the exotic space. You also have synthetic delta ones like Flux and Synthetics. But this is really a growing space that's really exciting to see what more protocols and companies are doing to bring options contracts to the blockchain itself. So a little bit more about the last category, the exotic options tokenization. So we at Cega, we're doing just that. We are creating exotic derivative contracts on the blockchain. We're live on Solana and Ethereum. And basically the way that it works is pretty straightforward. So you, the user, so any of you guys with a wallet with USDC, you can go into our app and you can deposit USDC. And then we trade that USDC in an exotic options trading strategy. Depending on what kind of risk you're willing to take, you can basically choose between different kinds of product offerings. But as an example here, we have a product called Supercharger where your bet might be, you're betting that the price of Ethereum or BTC will not go down by more than 30% within a month. And if you're correct, you'll get 10 to 12% APY. Right? So these are the kind of bets that you're making through Cega. The really cool thing about Cega is that exotic derivatives, like I mentioned with this nonlinear payoff, we offer a more customized, flexible view on the market. And what that actually means for you, the investor, is it means downside protection. So if you buy, for example, in options, if you buy vanilla options, when prices move up, when prices move down, you're subject to losses infinitely in either direction. With exotic options, we have what's called a barrier, which means that basically if the price does not go below a certain point, you actually are not subject to any losses at all. So this kind of downside protection is something that's really interesting and unique about what exotic derivatives can offer. So some of the problems that we're tackling that we're super excited about are in a few different areas. We are super interested in tackling problems around product innovation. So obviously, especially last year, I think, it was very common to see companies just forking each other on different chains, and that was called innovation. But these days, we think that there's not enough net new innovation being brought to the space, and we're trying to work on that. There are lots of interesting areas to work on. For example, lockup periods or ways to offer users more flexibility on what kind of tokens they can stake, what kinds of offerings and views on the market that they can take. Like, there's so many different and interesting aspects of innovation that we can bring to market here. The second area is we think that there today still in DeFi lacks a lack of real high yield. So if you're chasing yield today, there's a lot of really sketchy websites you might go to or a lot of projects that are unvetted. But we think that in order for DeFi to grow to the next level, you have to find real yield. You have to have your users understand where it's coming from. And so, none of the Ponzi-nomics, none of the inflationary token rewards, just literally, understandable yield. And the last thing is that we think it's really important to also make sure that there are good actors in the space, right? So at Cega, for example, you can talk to any of us. Like, we try to make it known that if you find any of the employees, if you find any of our team members or any of the co-founders, you know who we are, because we're here for the long run. Like, we are here to really help move DeFi along for the long run. So, hopefully users in the future have more trust in all the protocols in DeFi. There are less ruggings and there's more transparency. So, some quick facts about us. Since launch, we've already traded more than $250 million in notional. We are currently the #1 ranked DeFi protocol on Solana, which is where we started with about a year ago. And we just launched on Ethereum about 6-7 weeks ago, which is super exciting as well. So yeah, if you guys have USDC, please try out our product. Yeah, it's super, super easy to use, whether it's on Solana or Ethereum. And if you have any other questions, please let me know. Thank you.